Welcome back, guys. Chris Gunnels with Real Financial Success, and today we're going to talk about my June 12th earnings play, and you're going to want to stay to the end of the video so you see exactly how I plan on handling this losing trade. Now, if you didn't see my last video, go back and watch that right now because you're going to be confused if you didn't see it. I'll leave a link down in the description below, or I'll leave a link in the card above. Okay, so let's go to the chart to start, and I want to go over my assumption in my last video. Remember when I made that video on June 12th, you can see, let's see, I'll circle the little card right here. You can see, well, now of course it's in the way. I'll circle it right here. It's a card that pops up when I hover over this candle. See, it says 6/12/2018 at the top, and it was trading at the close at $29.60. And remember, in my last video I said that it's going to gap down when the market opens the next day. And what happened? It gapped down right here. And if you look at the card up there that's circled in blue, it opened at $23.82. So my specific trade was, if you remember, I said that it's going to gap down to 24, and I put on a trade for $1.40, a working order for $1.40 at the 24 strike price. Well, it did go down, right? It went down to $23.82, something like that. The actual table, the actual option prices, they weren't offering they weren't offering $1.40. They were offering around $1.07 for the 24 strike price. So that's what I went ahead and I traded the 24 strike price for $1.07. And not only did I have to lower my price that I wanted to sell at from $1.40 to $1.07, I actually also had to go out to the July 20th expiration to get that price. And I always want to get at least $1 or more for my troubles. And if you remember in my last video, I said that the market will probably go up during the day. Well, the very next day, June 13th, as it shows there on the card, it went up. The high of that day was, if you look, $24.72. So actually, I could have closed out that trade for, $20 or $30 or something like that. But my goal is to make 50% of the credit that I received. And the reason for that is because if you go and watch my other video where I talk about trading small and trading a lot, and the coin flip analogy, that 50% of my total credit, it actually goes hand in hand with that analogy. So go back and watch that video too if you haven't seen it. Anyway, back to this trade. I didn't close it out, and the reason why obviously is because, like I said, I didn't make that 50% profit of my total credit. Since I received $1.07 for the credit, I want to make around, was that 53 cents or something like that before I get out of this trade. So technically I could get assigned the stock right now, but investors don't like to lose money, so they won't actually assign me. And the question that a lot of people have is, how would the investor that I sold this option to, how would they lose money if they assigned me the stock right now? Well, let's go through the math. First, let's go to the risk profile chart. So let's break out the calculator. Remember, they paid me $1.07 for the option to sell me the stock anytime between now and July 20th. If they assigned me the stock right now, they would lose 62 cents of extrinsic value. How did I get to that number? Well, that's pretty simple. Let's take where the stock is at right now, where this little white bar is, $23.55, 23.55. Well, back up. Let's first start with our break-even price. 24 minus 107. This is our break-even price, $22.93. Okay, so since this is our break-even price, $22.93, and the stock is trading at $23.55, we would subtract that and come up with 62 cents. So that's the value that they still have left in their option. And if they assigned me the stock right now, I would actually make the 62 cents. So they would actually be doing me a favor, because I would take the stock that they assigned me, and I would immediately sell it in the market for $23.55. Remember, they already paid me $1.07. So if you do that math, that gives me 62 cents or $62 profit per option contract. Because remember, every option contract is worth 100 shares of stock. But I don't believe that's going to happen because, again, they have all the way out to July 20th, and they have quite a bit of extrinsic value left. Now let me explain to you how I'm going to actually manage this trade. What I like to do is I like to manage my trades at around 20 days till expiration. And right now, as you can see, the July 20th expiration date, we still have 32 days. So I have 12 days essentially before I even look to manage my position. At this very moment, what I plan on doing is I will roll this option out to August. Now let's look at the August contracts, August 17th, the 24 strike. So at the moment, I could roll it out. I would have to buy this other one back for $1.15, and then I would sell this one for $1.25, which would give me a net credit of 22 cents. You would add that 22 cents onto the $1.07, therefore making my break even essentially 22 cents less than what was it before? 22.93, I think is what it was. So I will manage this position with 20 days left till expiration, and I will either roll out this trade to August, or if it's out of the money, I will actually close this position for a profit. Okay, so this is the platform I was talking about. It's called Tastyworks, and you guys need to go and open an account with them right now. Remember, they have cheaper commissions, and they don't charge you to close your position. Okay, guys, thanks for watching, and remember to make small trades daily. And if you haven't already, go ahead and subscribe and ring that bell so you're notified when I've released more videos. Also, go ahead and comment below if you have any questions or if you'd like to say anything about this video. I stick around for a couple days just to answer your questions and just to reply to your comments. Okay guys, thanks for watching. Have a good one. We'll see you next time.